Welcome to the Inside Out Money Podcast.
Can't even recognize this place. Too many pieces of our past mistakes.
Hi, I'm Maggie, and I believe real change starts from the inside out. So let's work together to improve our money and our lives from the inside out. We will explore all things money and our relationship with it. Join me each week with a rotating set of co-hosts, friends, and interviews. Let's jump in.
This time, we going round and round and round and round and round.
Hey, Andrew.
Hey, Maggie.
How's it going?
Hot and humid in Atlanta.
It is hot and humid in Atlanta, for real.
It has felt like a rainforest outside for weeks on end now.
I went for a 4-mile walk with somebody today. I needed to have a lengthy conversation with them about something around a volunteer role. And I was like, let's walk. And we the time we could do it was around 3. And she was like, seriously, that's when you want to go? And I was like, well, I mean, what are we going to do? This is the temperature in Atlanta right now. But I was so glad we did it because it was so productive. At the end, I'm drenched in sweat. It was very hot. I was just drenched in sweat.
Yep.
Hey, I wanted to do one really random thing that I just thought about. I was at, where was I recently? And somebody, we were at some friend's house, and somebody was like, who does the intro? They listened to the podcast, and they were like, I met them through Campfire, and they were like, who does the intro music to your podcast? Where's that from? And I was like, oh, that's a friend of mine's band, and it's a friend of Andrew and I's. Yeah. So I was like, I should say it more often. But the intro and closing music is a cut from a song. I'll put a link in the show notes to it so you can go listen to it on Spotify or SoundCloud or wherever people listen to things these days. But it's Clap for Daylight is the name of the band, and it's a guy that Andrew and I used to work with, and then also randomly my ex-husband connected through me, started playing the drums in their band, and he doesn't anymore, but they it's a cool band, and
that.
Yeah. And so anyways, I was like, when that person asked me the question, I was like, oh, I should give him a shout out more often. So anyways, thank you to Clap for Daylight for letting us use their music in the intro and outro. Cause music stuff, you gotta have buy rights, or you gotta, I can't afford Taylor Swift rights for the opening. That'd be
Not
cool.
yet.
Yeah, not yet. And I don't know that Andrew would be that excited about Taylor Swift as our opening song.
I'm kind of become a Taylor Swift fan through my daughter.
Are you?
Yeah.
It's cause you got a girl. Yeah. Can't help it.
I've got Swifties.
Also, those tunes are they're catchy.
Yep.
It's hard not to like her. Okay, but we are not talking about Taylor Swift or Clap for Daylight today. We are talking about, you know what? I just welcome people. If you're not sure where you are, this is the Inside Out Money Podcast, personal finance podcast focused on redefining wealth from the inside out. Every week, I speak with a rotating set of co-hosts about a different financial topic aimed at helping you improve your financial mindset and tactics. Today we have Andrew, and this is I was just trying to tell Andrew this. This is one of the more intimidating topics to me because it's a little bit over my head. But I want to I'm going to learn with the rest of you guys. And I want this to be some motivation that just because you don't fully understand something right off the bat doesn't mean you can't learn more and still walk away with not understanding all of it, but understanding enough of it to, have it mean something, but not everything, if that makes sense. What are we going to talk about, Andrew?
We are going to talk about two concepts today that are pretty heavily related to the concept of FIRE, financial independence, retiring early. The first concept is what's called the CAPE ratio, and the second concept is the sequence of return to risk.
How do you say that acronym? Do you say SORR, S-O-R-R?
S-O-R-R. I say S-O-R-R. And then that's how it's referenced a lot online. And then the CAPE ratio, C-A-P-E ratio. So all caps CAPE ratio.
I needed you just to give that intro because I thought you might even be like, oh, it's called the CAPI or the, so, I don't know anything. I've roughly heard, I've heard of them, but even we were texting about, I don't even remember how this started. We were texting about something the other day and you mentioned SORR, S-O-R-R.
Yeah.
And I had to go Google it because I was like, what's he talking about? And should I know about this? This seems important. I'm early retired. Perhaps I should know about this. And then I was like, you know what? I think I did study this in business school, but it's been a while.
So on both of these topics, you can get extremely technical. There are kind of two ends of the spectrum, right? The CAPE ratio was discovered, created by Robert Shiller, Nobel laureate, Nobel winning economist. You can have a very deep, technical, highly intellectual conversation about the CAPE ratio, what it means, and all the different aspects to it. And then same goes with sequencing of returns risk, right? You can get very technical on it on one side, but then on the other side, there's a kind of the simplified version, and the one that's kind of from a practicality perspective, which is somewhat where I specialize here in terms of the practical side of some of these technical concepts. And so that's my goal today, is to just talk about make it a little bit simpler, easier to understand, and focus on why this matters to the FIRE movement and the early retiree, and things to consider with both of these concepts.
Andrew, I love that. And that is the reason why you're going to hear me not talk a lot on this episode and mostly ask you questions.
That sounds good.
And I want to give you permission. If I say something and you're like, no, that's not true, you're missing it, like, please call me out. Okay. I want you to
This will be a public learning session.
Okay, sounds good. And let me say my first statement that I think is true, but I want you to like keep me honest here. So if you're new to investing and you are still trying to you're like overwhelmed by what you should even do and know, like we've got some other episodes that I would say are like the 101 of that. So we did an episode, one of our first episodes, Andrew, we did how and why to invest in index funds, episode 3. We did episode 39, what's in our wallet. So we talked about what index funds we own, different accounts, etc. Greg and I did episode 52, where we talked about simplifying our finances and how we're moving from some of our money that was in robo-investing at Wealthfront and how we moved it back to managing ourselves essentially through Fidelity. And that to me is sort of the 101, right? Of you getting comfortable understanding, like, you need to spend less than you make, you need to invest the difference, and you don't need a financial planner. Oh, I'll add the financial planner episode to the show notes also, because you don't need a financial planner to do this. You can do it yourself. And I don't want this episode to result in you thinking you need a financial planner. But to me, this is sort of like, if those are all the 101, this is sort of like the 201/301 of like, it could be really overwhelming, like you said, Andrew, and super technical, but it doesn't need to be. You just generally understanding some of these concepts can be meaningful, and we'll sort of get into why it matters and why you would want to understand these concepts.
Yeah. All right, so we'll start with the CAPE ratio, and then we'll transition into the sequence of returns risk. So starting with the CAPE ratio, just at a high level, what it is, and it stands for Cyclically Adjusted Price-to-Earnings ratio, CAPE. And in simple terms, what it does is it takes the inflation-adjusted 10 years of earnings data for the market, and then it divides it by the price. And so if you think about, well, what is the value of a stock? The value of the stock is the underlying earnings of that company, often described as a PE ratio, right? So what is the earnings versus the price of the stock? So, a company like NVIDIA, for example, right now has a massive PE ratio, right? Super high value. While they have good earnings, their value is extremely high because investors are betting on the future that it is going to have has significant earnings power over the long term. And so the market puts a premium on that stock price, and that's why the price is high.
So, Andrew, just to clarify, the CAPE ratio would be calculated on an individual stock, not the market overall.
No, it's typically done on the market overall. So I'm just using an example of when you start with, well, what is the market? The market is made up of all the individual stocks. And so if you start with, each individual stock has a price to earnings ratio. Typically, the way the CAPE is expressed, most of the time it's just expressed as on the S&P 500. So you take the 500 stocks of the S&P, you take their current price and their earnings, and that's how you come up with over the 10-year period, adjusted for inflation. That's how you come up with the CAPE ratio. And so the benefit and one of the reasons why people like it is because year to year there can be more volatility in a PE ratio, whereas if you look at it over a 10-year period, that kind of smooths out some of the differences year to year. So when I talk about the market level, I mean, you could look at it on an individual stock, but typically people don't look at it on an individual stock basis. They think about this as what is the CAPE ratio of the total market, and or just the S&P 500, which is a good proxy for what the total market looks like. So the ratio indicates how either overvalued or undervalued the market is. And so the higher the CAPE ratio, the more overvalued the market is. The lower the CAPE ratio, the more undervalued the market is.
I think you should repeat that.
Okay.
As an important statement.
Right. The key piece to the CAPE ratio is that as the CAPE ratio increases, the overall market, the valuation of the market has increased, and people with a high, when you say, well, the market is at a high CAPE ratio, people would consider the market overvalued. If there's a low CAPE ratio, people would consider the market undervalued. And so it's very easy to go on Yahoo Finance or plenty of sites, and that you can just type in CAPE ratio and you can see it. What has the CAPE ratio been for the last, decades and decades of time, right? So you can see how it tracks. And so just for example, today's CAPE ratio, as I looked at it today, was right around 34. As far as
Andrew, I mean, really, it's 34.08. I just,
Thank
I
you
don't
for
want
that
to
correction. Right?
I'm just kidding. I Googled that too.
And actually, let me hold on.
That 0.08 really matters. Hey, the one thing I just kind of am confused about myself is when I had Googled it, it seems like people apply it to individual stocks also. And I just kind of I don't want to go too in the weeds for people.
Yeah.
You could do that.
Yeah, absolutely. It's
so in the same way that you mentioned how the CAPE ratio sort of lets you know if things seem under versus overvalued, that could happen at an individual stock level also.
Absolutely.
Okay. You're just more saying, just as we look, I mean, you and I agree on we're not buying individual stocks, we're buying index funds. It's more applicable from your point of view at an index fund or a S&P 500, more macro level view.
Correct. Exactly.
Okay.
So I'm just pulling up the data here so I can look at when it was here. All right, here. Okay. All right. So I've got a chart up here. Actually, I think as of today, 36.29 is the CAPE ratio as of today. And then if you go back to, for example, in January of 2009, right after the market crashed in 2008, the housing crisis, it was at 14. And then if you go back to
so back then things were undervalued because it was
correct.
post crash.
If you go back
people
to
believe things would go up.
COVID times, the dip in COVID, it went back down all the way down to January 2020. It was at 30. April 2020 it was at 27.33. So that gives you an indication of kind of where the 34 is, or the 36 as of today is relative to some of the other benchmarks. So this all gets very technical. In layman's terms, what does it mean? It means that equity prices are high right now, right? The market has gone, the bull run that we've had for the last couple of years has been extremely strong. We had a dip due to COVID, but it more than recovered that dip. But overall, equities are priced very high right now in terms of historical context.
Yeah, which means if you have a lot of money in the market right now, you're doing good. You're reaping the benefits of it.
Just to put that the 36 that it is today in perspective, historically, the average CAPE ratio for the S&P 500 is 17. So it's just an indicator of where the market is placed, and everyone agrees that things are high right now. And so, what does that all mean? It means that for people who are looking to retire early, they've seen everyone's chasing their FI number. People are targeting 25 to 35 times their current expenses to hit their FI number, which you can hear us talk all about that in the 101 and 102 courses, like you said earlier, Maggie. And I think the key concept here is that as you're calculating hitting your FI number, if you're hitting it as a result of this extremely strong bull market where equities are priced high, you have to be prepared that there's going to be a correction. I can't tell you when that's going to happen. Nobody can predict it, but there are indicators that the equity prices are high. Does it change any of my behavior? No, but you just want to have awareness to it so that if you just haven't hit your FI number right at the top of the market and suddenly the market market drops 20-25%, and suddenly you've quit your job and your portfolio is down 25%, and you can start having sequence of returns risk, which is the next concept, and why both of these tie together. So before we get on to sequence of returns risk, Maggie, any other questions about the CAPE ratio and how it's used, or how really it's an underlying, what does the value of the market look like, and how are valuations for equities today compared to the historical averages?
Definitely have some questions, but I will say I think you might have just answered one of my questions, so feel free to be like, I just said that, Maggie. So this is going to lead into a question. I want to repeat some things that you said also, just for my own sake and other people's also. So ultimately, the CAPE ratio provides a long-term view. In this case, we're not talking about individual stocks, so a long-term view of the market's profitability. And I love that example you gave on kind of FIRE. So if you're looking to leave and you finally hit this point of you've got 25 times your annual expenses, and for easy math, I'm going to say it's $100,000 in annual expenses, and you've got 2.5 million, and you're like, sweet, now I can like pull the cord and go. If we're at a point where we're kind of at a peak, which is kind of where we're at now in the market, within the next 6 months to a year, you may no longer have 25 times, to be like very clear about that. And again, there's a lot of people who, there's a whole nother topic for kind of how you manage your drawdown, and like you could decide, oh, well, I'm not going to spend 100,000 because the market's not doing well, and I'm going to really curb back my spending and manage to not pull 4% out. And there's a lot of ways you can kind of manage that. But to your point, I do think it's a really interesting metric, and I really wasn't something that I was super aware of. And I think it's a very interesting FIRE metric in particular. So it feels like it's a little bit of a version of like trying to time the market. Do you agree, or like do you think of it that way?
It is, if you decide to act on it very differently. It is a little bit market timing, but it's not like here's true market timing. If you were going to, as I interpret it, if you were to truly be trying to time the market, you said, hey, we're at the peak, you would sell all of your equities, you'd get into cash, and then you wait for the market to turn. I'm absolutely not saying that.
Right.
And I am a strong believer of dollar cost averaging. I continue to believe that to keep buying and to, regardless of the valuations, because you can't predict when it is going to drop, when it is going to be at its peak, and who knows what could happen, right? 34 could not be or 36 CAPE ratio may not be the peak compared to the historical averages. Yes, it is high, but the market could go up and be up at 40s and 45s. It's more unlikely that you hit those outliers because the fundamentals of the market would start to break down at that point. Essentially, you're saying that the earnings are valued at 40 times what they are, which there are other investments that could potentially generate more, and kind of market fundamentals start coming into play here. So
okay,
I think that, but yeah, true market time would say I'm selling all my equities and going to cash.
Yeah,
absolutely not.
And like a little baby version of that market timing would be, I'm hanging on to I'm still like I do this. I'm still dollar cost averaging and putting money into the market on an automatic weekly or every other week basis. But I am hanging on to some extra cash because I do believe there's some correction ahead of us or some adjustments ahead of us in the market. And I think we've been on a tear for a really long time and feels good, but I don't even like accept it as real.
Yeah, there's always a balance. The most conservative approach would be putting everything into cash. The most aggressive approach would be continue to put 100% of your available funds and have no cash on hand. I always think there's a balance in the middle.
Yeah, it's a good point. So what are you specifically doing right now financially in your life as a result of knowing and understanding the CAPE ratio?
I would say I have an awareness in terms of thinking about financial independence and retiring early. And ideally, I'm trying not to think about retirement at the top of the market. So I would say I'm not necessarily doing anything majorly different, but I have an awareness in terms of the decision and timing around when and if I would decide to retire. Ideally, I'm not doing it at the top of the market.
Do you think that early retiring when the market is at a peak, which we really never know, but things like the CAPE ratio would help us to have a sense of that? But do you think that retiring at a peak in the market gives you a false sense of security because it sort of like inflates that 25 times math?
Yes, absolutely.
Okay.
And so that's where I think it's important to have an awareness to it. And then maybe, this translates into the sequence of returns risk, because everyone is thinking about, well, what's my fine number? And then, well, once I achieve that, do I pull the plug immediately?
Yeah.
And so maybe that's a good transition into the sequence of returns risk, right? Because then this goes into that. So let's
SORR. These all have like Superman, like hero. Don't you think like superhero vibes, like capes and soaring?
I had not thought about that. Yeah, you got my Superman
immediately
cape
what I
on.
thought about. I'm a simple person, Okay, so let's talk about SORR, which this is all I can tell you about SORR. It stands for sequence of returns risk. Andrew, what does that mean?
So this means that you can look at averages over the years for your investments, but the actual, and people are always thinking about, okay, I'm going to use 7% in my model, average return of 10% with a 3% inflation, real rate of return of 7%. Well, it's not like you're going to get 7% every single year consistently, right? You're going to have ups, you're going to have downs. And what the sequence of returns risk is it talks about the order in which those returns happen matter. And I think it's sometimes a little bit easier to think about sequence of returns risk the opposite way versus thinking about it as part of your retirement. Think about it the other way in the accumulation phase, because the exact same principles apply. In the accumulation phase, you actually like it when the market is down because you're continuing to buy in, and if the market is down and you're continuing to buy in on the accumulation phase, that's actually a good thing, right? Because you're buying in.
You're buying low.
You're buying low. Well, the reverse also happens when you switch to the withdrawal phase, in that if the market drops during the withdrawal phase, your balances take a hit. And when those balances take a hit and you are having to withdraw, the base at which you start at when you start to, the market eventually will recover. But the base at which you start at, the recovery is starting at a lower base. And so while your returns, the market will return, whatever the market is going to return, because you have started at a lower base, when you blow that out for decades, 20, 30, 40-year retirement, because that base was at a lower point, you are now going to see a dramatic impact over that 40 years on your portfolio.
Which initially sort of confused me, Andrew, because I will say there was a time when I, a bit unknowingly, uneducatedly, however you want to say it. Is that a word? Uneducatedly?
Uneducated.
Yeah. Ironically, no, it's not a word. So there was a time when I sort of in my mind was always like, I can't. So part of this is true because in theory, like you just can't perfectly time an early retirement. Like there's life situations and circumstances that you might want to do it around. But I also was like, well, it doesn't really matter what's happening in the market. I now have changed my tune, and I honestly think understanding this is, like you said, there's a lot of complexities to some of these concepts, but there's also like such a simple point in there, which is, and I'm just sort of admitting, like, I didn't really understand it until recently. So I really sort of was always like, oh, it doesn't really matter what the market's doing. I almost have to have blinders on and just like live my life and keep acting by the principles I believe in. But ultimately, my inflection point of early retirement for me, and as a good case study, is it's when I quit putting money in because I quit making money and I'm just taking money out. Mm-hmm. Right. And so to your point, how the market is performing at that kind of inflection point in time actually does have an impact on your longer term performance. And I just never really gave any credit to that, honestly. But I get it now. So better late than never. And I kind of got lucky, honestly, with the timing of my early retirement. I fell into it.
Yep. And there are a lot of things in life where timing matters, and this is absolutely one of them. Now, on the flip side, even if you look at the, people talk about cohorts, right? Which year, which cohort. If you look at the 2008 retiree cohort, right, they retired at possibly the worst possible time, right? The 2000s when the dot-com bubble burst, people retired that year. Same with the people who retired in 2008 with the housing crisis. If you actually look at how they've performed, they've still done, like, there are not, when you look at the 3.5 or the 4% rule, like, they're still doing okay because the market recovered enough to offset it. But if you also think, I'd like just using an example here, a lot of the research on retirement in general and the 4% rule was done from the Trinity study and looking at a 30-year retirement, right? Well, if you're looking at retiring early and you're looking at more like a 40-year retirement or even a 50-year retirement, let's just use the 40-year example. If you were to retire and at 45 and you were looking at a 40-year retirement to 85, if you were to retire at 45 with $1 million portfolio and in the first, call it 3 years, the market tanks 25% in those first 3 years, your portfolio is now 750,000, and you're now looking at a 37
Still
year.
got most of that timeline ahead
Right,
of
you still have most of that timeline to go.
And you probably spend some money those 3 years on top of it. You didn't earn money, you spend money.
You would have so that portfolio, the market drops 25%, which is not unheard of. Now you're at 750.
And then you spent 5%.
And then you pulled out potentially 50, 75. If you, let's just easy math, right? If you pulled out 75K for minimum 2 years, maybe that third year you started realizing you had to cut back and you were down to 50. So, maybe you're looking at you pulled out 200K. So market drops 250, and then you pulled 200K out in order to potentially, actually that math doesn't.
Well, that's not good math because you never, if you needed 200K to live,
right,
1 million wouldn't have been enough to retire.
Wouldn't have been enough. So,
but you would have pulled out about 4%, right?
So if you pulled four, like
in the simple math, you would have pulled out.
Simple
40,
math, you would have pulled out 40,000. So 43, so 120. So now you're at 750 minus your 120. And now you're looking at, what's that, 630, right? So now you're
I'm not validating that math, by the way, but I get the concept.
Yeah. So I think it's 630, right? So if the market dropped 250K, 25%, and then also you pulled out, because you were just going by the 4% rule, you were going to take out 40,000 every single year. You pulled out 120 to get to now your balance is at 630. Starting at 630 is a very different number from starting at, where you were at $1 million, right? So like your perspective on, hey, I put it in my great little Excel spreadsheet, I put in 8%. I thought that my values would have been, 8% higher every single year. I'm now looking at 1,100. Your portfolio is now cut in half just because of some really bad timing. And so that's where this all kind of plays together in terms of the thinking about your what is your FI number and making sure that you've got some wiggle room in that. And so especially when you're looking at equity values that are elevated compared to the historical averages, and then the first couple years of your retirement, those initial years are very important when you play them out over 40 years of what your portfolio will look like.
And to something you just said, and just kind of something I was thinking about, when, like, you can't always perfectly time when you are going to early retire or take a sabbatical or make a change or switch to part-time or become an entrepreneur or whatever your life shift might be that requires some level of financial independence to get to. You can't always perfectly time it around this, because it might be something about the age of your kids or a life stage thing or a sick partner or you're sick or whatever. What you can do, though, and you said this, is you can pad your number, right?
Absolutely.
So you can say like, okay, I think I'm going to retire in the next year, and this doesn't look like a good time based on SORR. And you could say like, so as a result, we're going to get even tighter in the next year, and we're going to, earn more money, and that our goal of $1 million, we really want to bump up to 1.3 million to give us some padding. Yeah.
So okay, we know about the CAPE ratio and we know about elevated equities in the market. And then we know about now sequence of returns risk, where the first couple of years are extremely important regarding the long-term value of your portfolio. So how do you go about minimizing these risks and building some, protecting yourself against them? The first one is the padding of the number, right? So if you had your goal of making, the 2.5 million to get your 100K return, you can bump that up. And so, if you say, okay, I want to protect myself against a 10% market drop. So now I'm going to bump my number up 10% above that. So 2.5 million, 10%, I'm now going to make it 2.75, right? And so then you say, okay, that's going to be my fine number. I'm going to go to 2.75. That will protect me so that even if the market drops 10%, I'm going to feel good about where I am. And so on the additional thing you can do outside of just padding the overall portfolio value is thinking about what your withdrawal rate looks like, right? So if your withdrawal rate is more conservative, and this is one of the reasons why people advocate for a lower withdrawal rate on a longer term retirement, you can set your withdrawal rate to be lower. And by definition, if you're setting your withdrawal rate lower, your overall portfolio value is theoretically going to be higher, right? And then the last thing is you adjust your expenses, right? So that's the thing with a lot of this FIRE planning is that people are always assuming, well, yeah, my expenses are going to be fixed, or I'm actually going to spend more. And I agree with people that most likely for the early retiree in their 40s, they're going to spend more than the retiree in their 60s or 70s because I'm
proof of that.
Maggie going to Australia on a 4-week vacation.
It was only 3 because I adjusted based on my new understanding of the SORR and the CAPE ratio. But I get your point. Yes.
But so I do believe people will spend more in retirement when they're in their early retirement. But also there's a difference between a lot of that additional spend is potentially discretionary versus actually what are my actually hard fixed costs. Like if the market dropped 20-25%, could you actually cut your expenses and thus drop your withdrawal rate? Yeah, if you got
100. Right? I know I could. I mean, speaking for myself, our expenses have increased since we retired, but we 100% could reduce them dramatically if we needed to.
Yeah,
and to your point, some of these, like this sort of information would inspire me to say, oh, like I'm super motivated to pull back for a couple years. If the market, if upon us retiring, the market immediately tanked, and I then understood this, which I do now, to be clear, I very much so would have been motivated. But right now, honestly, I'm a little motivated to spend because I'm on the opposite end of that, right?
Yep.
I'm seeing, I happened to get really lucky and just retire at a point where the market has been on a tear and a tear is a good thing, by the way, since we retired. I went back and looked. I don't even like saying this sometimes, Andrew, because I don't mean it to sound braggy. I mean it to provide motivation to people out there. I was scared of a lot of things. I talk about that. We have entire episodes and entire talks I've given of all the things I was financially afraid of. I'll put a link in the show notes to them. But it's like the proof is in the pudding. And it's easy to not be as afraid when you've had the first 2 years of retirement that I've had, which is the market's done really well. And I look back at how much my money has grown in the past 2 years, and it feels really good, right? And again, it's a little bit of dumb luck on the timing on my part, right? I just happened to be here and my timing happened to align well. But it's kind of what you want in the beginning of your retirement in a perfect world. Yeah.
And I think it's important just to have awareness of this and to not to be surprised. If the market dropped 15% in the next 3 days, you would be disappointed, but I don't think you would be surprised at it because of what you know. You know that equities are highly valued right now.
I'm kind of expecting it. Not in the next 3 days, but
right. But imagine if you were in a different situation, right? And you had just kind of really squeaked by on hitting the FI number and your withdrawal rate was actually kind of a little bit over 4%, and you'd probably have a different mental framework if the market were to drop. And so I think it's just important for people to have an awareness that while the run up, the bull market has been great for people starting to achieve and hitting their FI numbers, just know that things can change quickly, as we saw with COVID, and just to be aware of it, that you may need to make some adjustments, right? None of us can predict the future. None of us can know exactly how things are going to play out. But having a plan, having some conservatism built in, some people would argue, well, Andrew, you're just going to be overworking, that in 20 years, you'll look back and say, you didn't need to work for those last couple of years. And I would say my response, this is a little bit die with zero, right? My response to that would be, yeah, I might have worked 2 or 3 more years than I needed to, but I slept a lot better at night knowing
that gave you the buffer and peace of mind. And I often think that I'm like, oh, now that I see where my money's at, I'm like, oh, I could have left a couple years earlier, but you can't predict this stuff. And I feel, and still, even knowing how well things are, I still feel like I did the right thing with the information I had available to me at the time. And I wasn't even, and you got to get in the right mindset for it too. It took me years to build up the confidence to take that plunge and to do it regardless of the math, quite honestly.
Yeah.
So yeah, I think SORR in particular, is it okay to say that acronym, or do people just call it SORR?
I think you say SORR. I think most people wouldn't understand that. I
I
don't know if I've heard other people refer to it as SORR, but
I just made that up. Well, okay. Just like the slang. When I was in Australia, they have like great short words for everything. like a municipal buildings, like the Muni building.
The Muni, yeah.
Avocados, everything is like shortened, and I really liked it. So I'm just going to call it SORR because, SORR is like a lot.
It is a mouthful.
I just cut 3 syllables off there.
Right.
But I like it because it's even though like you said, you can get into a really technical explanation and like all the, math and numbers behind it, it's actionable, right? And understanding those strategies we can do to actually mitigate it depending on the timing of somebody, again, leaving a big job or making a big life change or whatever they might be doing is that to me is where it's interesting, because a lot of these concepts, they just kind of like go right over my head when I don't see how it's clearly actionable.
Yeah.
In real life scenarios.
And one more thing to tie these two things together is that there are a bunch of FI calculators out there that have a CAPE ratio withdrawal strategy. And so that is where you adjust your withdrawals based on where the CAPE ratio is. And so some people will adopt that versus a straight flat percentage to have some type of variability into their withdrawal strategies based around where the market valuations are.
Interesting.
One more important thing for mitigating SORR. Well, when we said padding the number, padding your cash balance is super important for mitigating SORR, right? If you have a couple years worth of cash built up that you don't have to touch those, in terms of your total asset base, right? If you've got, using the 2.5 million example, trying to get to 100,000 spend each year, if you have 250K in cash and you only have 2.25 million in equities, well, that 250K, that can sustain you for 2.5 years. If you look at the graphs for sequence of returns risk, like the first 5 years will really matter. You kind of got yourself covered for the first half, right? Could equities be severely depressed for 5, 6, 10 years? Absolutely. But if you have yourself covered for at least the first couple of years,
you further mitigate that risk.
You further mitigate that. There is no risk to sequence of returns because you're not having a withdrawal.
Yeah.
I shouldn't say no risk. You're minimizing. You're minimizing because you're not taking the money out. Yes, your portfolio balances would drop in those first 3 years. But the real pain is when the portfolio balances drop and you're having to take the withdrawals out because then you're selling low, right? Yeah. Which it's the exact opposite of, hey, I'm buying in low. So that in that scenario, it's a good thing for when you're adding money to the market. When it's at the low point. And it's a really bad thing when you're having to pull that money out to sustain your living expenses.
And back to the example of like that inflection point of you leaving a job is when you're no longer putting money into the market. You quit adding to that and you're now pulling out. Well, in the case of you keeping cash, you're no longer making money and putting it into the market. But to your point, Andrew, you are not having to take money out of the market. So that is a really, really great point.
Exactly.
Andrew, you have a very good skill of being able to take rather complex topics and simplifying them. And I think you've done that because I think I'm a good test case for it. And
thank you.
It makes more sense to me even after this discussion.
Good.
So well done. I think you did your job today. And by job, I mean your
I'll send you my invoice.
Well, thank you, Andrew. I really appreciate you taking some time to talk through this, and I appreciate you guys listening. We always know your time is limited and valuable, and we always appreciate you spending some of it with us. If you've enjoyed this episode, please give us a written review on Apple Podcasts or Spotify. We always appreciate it.
We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you, and you can leave a voicemail or text us at 404-981-3370 or hit us up on Instagram.
Awesome. Thanks, Andrew.
Thanks, Maggie.
Bye.
We're going round and round.